Hi everyone. So let me start this video by first introducing myself. This is Ashnath Kothari here. I am a qualified associate actuary. I have cleared 14 actuarial exams out of the possible 15 and have cleared all of these in the first attempt. I have also secured All India rank in two papers, CT6 and SP5. I have been teaching for more than 7 years now. Started when I was second year in my college. On the professional work front, corporate side, I have experience of working in PNC insurance sector. I had previously worked with AXA XL. I'm a graduate in economic honors, and I also was the BSc department topper in my college from Calcutta University. So that was a brief introduction for ones who are watching our video for the first time. So in this particular video, we are going to be discussing the tentative solutions for CM1 Paper A, which had come in IFoA April 2023 session. Now, before we get started, discussion of the paper, let me just inform all of you that the new live batches for IFoA September 2023 and II November 2023 session is starting from May 7. Admissions are open for it. Do keep in mind, we just have one single batch for each term, for each exam. Classes will be available in live online mode, in live offline. Currently, our offline center is in Kolkata and in pre-recorded mode as well. All the students who join us do get a chance, or rather do get access, complete access to all the pre-recorded content. And along with that, they have the option to attend the live classes, either in offline or online form, whichever is convenient for them, as per their availability. We would be creating study groups wherein we share the weekly tasks to ensure that all students, be it ones who are currently studying in the college, be it ones who are working, have something of a target, so that they can plan their studies accordingly and they always have the constant push, or let's say external motivation to be regular with their preparation. Now, as for the mode of our classes, most of our live classes would be on the weekends. That will ensure that students, whether working, not working in college, can attend the live classes and the timings does not clash. There would be certain live classes on weekdays as well, primarily in the initial stages to ensure that preparation, that syllabus is being covered at a good pace. We intend to complete the syllabus from our part around first week of May itself. So basically from 7th May to 7th August is what we are targeting right now. Now, the focus of the live classes is basically to ensure that the students studying for a particular paper in a particular batch have all the adequate concepts. It could be that we are teaching primarily in a particular session for a paper, paper A concepts. It could be paper B concepts. It could be question solving, doubt clearing. Point is, wherever the students who are studying from us in a particular session are facing issues in, the live classes would be, focusing on them so that these concerns or these doubts queries are resolved and we can make sure that a student has a pretty good learning experience, not just from exam clearing point of view but also from the point of view of being able to understand the concepts and the ability to apply them in the ever changing real world scenarios. We always motivate students, or we always push students to start early. I personally feel that starting early is one of the most underrated things in the eyes of others, but something which is extremely impactful. To promote that, we are having attractive early bird offers for ones who are enrolling for the classes by April end. These are customized on an individual basis depending on which papers they have cleared, which papers they are planning to give. So, in case you're planning to start your preparation under our guidance, do join us today for a meaningful, impactful, and wonderful learning experience. Now, to begin with the session on the discussion of the paper, overall, this CM1 paper A was one of the easiest I have seen under the new curriculum. Prior to that, certain CT1, CT5 exams have been easier, but if what I recall among the CM1 from 2019 onwards, this paper A was probably one of the most easiest. And when I say easiest, it was with the type of question which was given and the quantum of calculations involved. So there was a very small proportion of questions in this paper which required, a very large set of calculations. Question 10 was one of them. Apart from that, relatively, ones who have prepared well, practiced a lot of questions, would be able to make out, that this was a relatively easier paper. When I was interacting with certain of my students, they did mention that, a couple of them did complete the paper 1 hour before time. As for me, I solved the paper, I solved this particular paper on not on Word, but just on the usual paper itself. It took me around 1 hour 40 minutes. Had I done it on Word, let's say another 30 or 40 minutes additional. So overall, this was a relatively easier paper. As for the expectation of pass marks, it could be anywhere between, let's say, 55 to 60. Depends on CM1 B part as well. Certain students did find CM1 B slightly tricky. So let's see. Overall, basis paper A, I think that there would be a bias towards the passing marks being high, but it also depends on the mix of students who have appeared for the papers. CM1 being usually one of those exams where students appear for the first time. So many of them do tend to sit for this exam with not adequate preparation, and therefore, the pass marks or the proportion of students clearing could be lower. So we get to know that once the examiner report has been released by IFoA. Also, do keep in mind these are the tentative solutions. In case you find any sort of errors, be it with respect to calculation or formulas being used, please let us know through the comments section. We would push in rectifications for same. Do keep in mind when you're watching this video, do take a look at the pinned comment section as well, because in case there are any rectifications post uploading the video, we would be pushing through those section itself. And other than that, if you have any queries with respect to the way we have solved a question, with respect to certain other answers you might be getting, do let us know through the comments section. Also, obviously, if you find the video helpful, do like it. And don't forget to subscribe to our channel so that the later videos which we would be releasing, let's say for CM1 paper B or for other papers, you do get updated whenever we release these videos. So now let's get started. The first question is describe in words A def B choose x plus 1, and the second part is calculate showing all workings. So this is nothing but the probability that a person aged x plus 1 and subject to select mortality with a duration of 1 year would die between age x plus a plus 1 and x plus a plus b plus 1. Calculation we have performed. Do keep in mind that the question states that it needs to be AM92 select. Now, this was a straightforward question. Most of the students I have interacted with have got this completely right. Question 2. A general insurance company has set up a generalized cash flow model for the claims payment it will pay arising from its portfolio of car insurance policies. Describe the cash flows with reference to the certainty and uncertainty of size. So on this, if I talk about a car insurance policy, there's something called own damage or body damage. There is something called third party liability. Okay. So the cash flow size could be very uncertain, especially for the liability part of claim. These could be very high or there could be large variability. As for the body damage part, again, these could be variable, but let's say if a car, it's a new car, it's being valued at rupees 10 lakh, the damage could be anywhere between, let's say, 10,000 to even, complete damage of the model in case of a severe crash, it could be 10 lakh. So the timings, I will say, for the own damage is something, it might be a little bit regular as compared to the third party liability ones. Those could be extremely long tailed in nature. So the timings of payments, in short, will not be known in advance. The certainty of size will also not be known. For body damage, yes, we can have a high probability associated with the claims being from a particular range of values. But for liability, it could be extremely uncertain. So this was the theoretical part. Certain students did struggle with this. Next, question 3, calculate A82.254 showing all workings. One of the mistakes before getting into solution is students took AM92 instead of PMA92 C20. So there are multiple ways in which one could work. I have used one way. Later, I realized there's another shorter way which could have been used to calculate this. So this is the way I have used. Keep in mind a similar question, something like A73.254 had come maybe in the year 2017 or 2018, I don't recall correctly, but a similar type of question has already come. So ones who had practice well should have been able to tackle this. So what I'm trying to do is we have a annuity payable in arrear to a life aged 82.25, and these are quarterly cash flows. So the first cash flow will be at 82.5, then 82.75, and from 82 onwards. My target is to get this age to a integer. because that's how I'll get the values from the tables easily. So this is the first cash flow at 82.5. This is the second cash flow at 82.75. And then what I do is I go and stand at age 83. From there, another cash flow is there at 83, then 83.25, so on. So it's nothing but basically your annuity payable in payable every quarter, and this will look in the form of advance. And then I further discount it for the 0.75 years to bring the present value back to 82.25. Now the question hasn't stated anything, so you could either assume CFM or UDD to compute these probabilities: 0.25 p 82.25 and 0.5 p 82.25 and 0.75 p 82.25. To make my life easier, I assume CFM because that is usually a relatively quicker way to compute probabilities as compared to UDD. Again, a different answer would have come for students using UDD, and that will also be a acceptable solution. So these are the calculations. These are the steps, and the final value which I'm getting is this. Next, we have question 4. Again, relatively straightforward, but there were certain silly errors which certain students were making, or certain errors with respect to their interpretation of the question. So we have been given the dependent probabilities, we have a structure of the model, and then a certain changes has been proposed to the independent mortality rate, and we need to find the revised dependent decrement rate. So this is the structure of the solution. First, we try to find, let's say, the independent forces of decrement denoted by D and E. We have calculated that it's coming out. These are the values. Next step is basically we find the independent mortality rates. Okay. Using the independent forces of decrement, we can find the independent mortality. And now the mortality rate will be 70%. And now using these two, first, I'll find the new force of decrement, and then the revised death rates can be calculated using these formulas. So it's coming out to be 0.174 dependent probability of death and 0.370 for dependent probability of escape. Next, question 5, a random variable has been given. We need to describe in words the timings and amounts of the benefits, expenses, and premiums of the policy. So briefly, I have written these. It's a temporary annuity that pays 1500 per annum in earlier with a maximum term of 15 years. That basically there would be no cash flows beyond 15 years. There's an initial expense of 203% of the one-time premium. Premium is payable one time at outset, renewal expense of 35 incurred at end of each year. Or you can think along with payment of each of the annuity payments. Next, we have question 6, which is an HSD model. Part 1 asks us to show that the expected value of benefits is 1054. The best thing about such questions is you know whether your answer will be right or wrong. In case it is wrong, you'll have the chance to rework it. So I always, prefer, even when I'm appearing for exams or even when I advise to students, is that you should be happy when you're getting such questions, which is asking you to show that because you already know the answer. So now it's relatively easier to, just cross check. If you're getting the same answer, you do not have to spend any much time in revising it because you can be sure with a high degree of confidence that your workings are correct. So these are the workings. And then as per EPV of premiums for the part 2, it's coming out to be 176.73 up till 2 decimal places. So this was also a relatively straightforward question. Most of the students have got this correct. Question 7, it's from term structure of interest rates, a typical immunization question. So let us take a look at the solution for same. We have the present value of liabilities. We have the present value of assets. Describe what X and Y are. We basically equate the present value of assets and liabilities, and we also equate the first derivative of same. So these are the equations which I'm getting. And on solution, these are the values of X and Y which I'm getting. Now in part 2, basis my interaction with a couple of students, I did see that they interpreted the questions slightly differently. They were computing everything again at 8.5%, but that is not something which I think is required. Estimate using the volatility. The question clearly states to use the volatility. to calculate the percentage change in present value of assets if the interest rates were to increase to 8.5% per annum effective. So we can think this to be a small change, although it's not actually a small change from 8 to 8.5%, it's 0.5%. So the change is 0.5%. We need to compute the volatility. Multiplication of that will give us nothing but the relative change in the present value of assets. So I find the volatility is coming out to be this, and therefore the rate of change in present value will be nothing but this. This is nothing but the rate of change 0.005, 8 to 8.5%, and then the volatility part. And there will be a negative sign which is missing over here. So that shall be there. Now, question number 8. This is from Joint Life, a relatively straightforward question from Joint Life, I would say. Nothing much of a variation as such. So let us quickly go through the solution for same. These are the terms: 20,000 AD 60M12 plus 15,000 revisionary annuity payable to female, and then a term assurance payable to male in the event of death within the first 5 years of amount 2 lakh. These are the part-wise calculations. I always advise students to show their workings in examination. Might take a bit more time to type, but it ensures that if your final answer is not correct, you can get as much of step marks as possible because the examiner would know where you might have went wrong. So whenever you're writing the scripts, as a best practice, always try to write it from the point of view. Let's say if you want to, mark somebody else's script, how would you want the script to be? You wouldn't really want to spend time understanding it. You would prefer things to be made as clear as possible. Obviously, examiner will have a certain level of prior background to understand certain steps, but try to make the life easier of the examiner. So these are the various calculations. Again, some of them might have, calculated, let's say, they might have kept this in A bar itself. You could have used A bar 60 as 1 minus delta A bar 60. That would have given a slightly different answer, but would have been completely acceptable as well. So what I'm getting is to the nearest pound, I'm getting it to be 4,16,024, 416,024. Question 9. It's from basically interest rates chapter. So let me quickly take you all through the solutions. First is the capital gains test. We don't have a capital gain. We have a capital loss. Now, in the question, if you'll see, the term has been given to 10 to 15 years, right? And we need to find the maximum price over here. So had it been capital gain, we consider the worst case, which is redeeming as late as possible. In case of capital loss, the worst case is redeeming as early as possible. So we take n as 10. And see, first I thought there's a capital gain, so there's a subtraction term, but then because there's a capital loss, this term will not be there. It's coming out to be 1.84 per $100 nominal. Then these are the workings for part 2. We again make the capital gains test. We in fact have it. It's coming out to be 105.26, and in third part, equation is there. You need to perform interpolation. I've not shown the steps here. You need to show that. So remember, if you're trying to do using directly from tables function of calculator or goal seek, that will not be given full marks because the question has categorically stated using linear interpolation. So 4%, 5% is there. Once you apply linear interpolation to these values, you will get as 4.22%. So most of the students did get this question right as well. Straightforward. Question 10. Not, I'll say, the most challenging question, but the one which required the most amount of calculations and a bit slightly lengthier calculations. So part 1 is where most of them did get it right. Part 2 was one, where certain students did make certain errors. So let me quickly take you all through the solution. This is for part 1. As a best practice, I try to, had I been giving the exam myself, I would try to list down these values from tables so that later when I need to use these values again, I do not have to refer to the tables again. It's there. Just keep one thing in mind. Be very sure you're noting down the correct values from actual tables. It's a very common mistake, which many of us tend to make, this silly mistake. Certain digits get replaced. Instead of, let's say, 4.84, we might write 4.48. So just cross check at the time of writing itself to ensure no such errors are there. So these are the other set of in between values. And finally, after computing them, I'm getting this as 2786. Part 2 mortality profit is nothing but expected deaths minus actual death into DSAR. DSAR over here will be 55,000 minus 10V plus 20,000. If we'll take a look at the question, we are talking of the year 1 Jan 2022. This is nothing but the 10th year. There is a survival benefit being paid at the 10th year as well. So my DSR will be of this form: 55,000, that is the sum assured on death. You can calculate in the 10th year itself 55,000. And this term will be 10V plus R. If you would remember, once you have studied from us, this R is nothing but the survival benefit paid at the end of the year of interest. Now 10V we need to compute. So this is the particular equation. Now note that 55,000 is being paid at 10th year. After 10th year, in the 11th year, the benefit amount is coming out to be 50,000. So this is the structure. Premiums are being paid for first 10 years only, not for the entire 15 years. If you'll read the question, it's mentioned clearly. Level premiums are payable annually in advance, ceasing after 10 years. So even when I was solving it, I had mentioned the 5-year term. Then later, when I was cross-checking, I saw no, it's not 15 years, it's 10 years. So this was another mistake which a couple of students have made. So these are the in-between workings. And finally, I'm getting 10B as 15,845.52. DSAR is coming out to be 19,154. And then I'm getting a mortality loss of 7,537.29. Comment part is my DSR is coming out to be positive. So in that case, if we have more deaths than expected, we'll be having a loss. And we see that the actual deaths is more than the expected one. And therefore, we are having a loss. So this was the overall paper. Hope that you did find this video useful. We would be releasing the CM1 paper B solutions as well in the coming few days. Thanks everyone.